Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Target. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest.
And I'm Callie Cox, Senior Investment Strategist at Ally Invest.
All right, Callie, as usual, I have a one-year chart, a daily chart of the S&P 500 index up. Nothing too exciting in the chart except for the fact that we're back in a strong bullish move in the S&P 500 index. So I'm going to highlight just a few points here. Most of the year, we've had the moving averages line up perfectly in a bull market. We had the 200-day below the 50-day, below the 20-day. We did have that little downturn. This right here is considered a death cross. Now, to me, I don't put a lot of weight in this overall, but when a quicker moving average passes through a slower moving average to the downside, they would call that a death cross. They put a little bit more weight when you're talking about the 200-day moving average overall. But if I see this happen here, that actually just means that we don't have as strong of a bull market as you would if they all lined up. And then over here, we actually had what's called a golden cross, where the 20-day moving average came back and moved back up through the 50-day moving average. So after that, we had 6 solid days of up moves in the S&P 500 index, set an all-time high, had a little bit of a pullback, actually not too much at all. And now we're back looking to try to set an all-time high again in the S&P 500 index. Could happen today, the way the markets are going so far. Okay, so straightforward, very simple chart in the S&P 500 index. But as I was going through my charts, I thought I saw something interesting in the IWM, and I thought I'd draw your attention to it because I actually had a trend line that was drawn because we talked about the IWM a couple of weeks ago. I think it would be episode 85 or so. You can see it inside the playlist. And I actually had this trend line that I had drawn that starts in the middle of March and was, the big upturn in IWM. IWM kind of led the markets higher through this time period. And it's a very strong trend line. We got some real solid touches where it bounced right off of it. A lot of congestion in the middle of the channel right along this trend line. And it's interesting in that we did have the breakout that we were talking about on the show a couple of weeks ago, a solid move, about a 5% move, just less than 5%, about 10 points up to this level. But it actually got to that trend line, which, I might not have drawn if I didn't already have it inside the chart. And it hit that and it bounced back. And now in this marketplace, it's a good sign if we actually do come down a little closer to the breakout and make it a little bit more of a bounce up. That's usually a more solid trend, as long as now that resistance that we broke through to the upside finally after, what was it, almost 10 months of channeling in the IWM. We finally had that break to the upside. If we come back and test and it does actually hold, and you see we also have the 20-day moving average. So right in this area is a very interesting area in the IWM. And I just thought I would bring that back up because the chart just looks interesting, much more interesting than the S&P 500 index. So with that said, let's talk markets. What do you see going on this week, Callie?
Yeah, Brian. Well, let's talk markets. And thank you for kicking it off that way. I think you just explained exactly, what we're watching. Because, honestly, fundamentally, there's a lot to think about, but markets don't really seem to care. So let's talk about stocks today. So the S&P 500 is up about 60 basis points today. Seems to be on a slow trend higher and gunning for record highs, which coincides with your chart, Brian. Works out really well. And like I said, investors have a lot to think about. There's inflation, earnings, there's the Fed, there's the debt ceiling debate coming up. But per usual, none of this seems to faze them. Now, the inflation conversation, I do want to talk about that a little bit. The inflation conversation has changed quite a bit in the past week because last week we got CPI data that showed prices showed consumer prices accelerating at the fastest pace year over year since 1990. And that was a while ago. So it seems like the conversation has really shifted from how long could this last? Obviously, it's lasting a while and inflation is sticky, to more of how bad could this get? I've noticed that anecdotally, and from the research pieces I've read, that seems to be the next worry here. And it looks like prices could stick here, which is another worry. Like I said, inflation is very sticky, has been sticky in the past. So generally, when prices go up, it's harder to kind of make them go down and make them fall to the levels that they were at. So that could mean persistently higher costs for companies and for consumers. But I just mentioned all these things, but the market's up, and the market seems to be looking at growth expectations. They're high. Confidence measures, most of them are high. I know we got a U Michigan number that was a little surprising, but in general, confidence measures are high and spending is high. And it seems like consumers are willing to pay higher prices too. I mean, we just went through Q3 earnings season and S&P profit margins barely flinched. Plus, there seems to be some newfound evidence that supply chain pressures are easing. And like we mentioned before, the market is way past the supply chain narrative. That's why we've seen spots like semiconductors, transports, and retailers rallying. So knowing all of that, putting it all together, it's kind of understandable why stocks are pushing higher. They're just, trying to look at the cup half full instead of cup half empty. And, we've got these strong seasonal tailwinds behind us too, and an infrastructure bill that has been in talks for a while, but it was just signed. It's a definite thing now. So you've got a recipe here for a durable market, especially if you look at the fundamentals. The one thing that we're watching for right now is inflation. How bad does it get? And that's TBD. The Fed seems to be very aware of it. And the Fed is another wild card there, but right now they seem to be pretty content with tapering. Now, I'll warn you too, you can't overlook the possibility of a pullback. Pullbacks happen even in healthy markets. That's our motto here at Ally Invest. And as I'm sure you know, it's been a fairly smooth ride for most of this year. So it's possible we see a drop, especially with the market rotating into the supply chain friendly sectors. Because when the market's rotating into something, it's rotating out of something else. So you could see that churn underneath the surface, and that could lead us to a pullback. So, if you're thinking about a pullback, think about adding some defensives, maybe some value stocks. And if you're worried about inflation, think about cash flows now versus later. If you believe growth could be strong, and I'll go back to that small caps chart that Brian mentioned, because I know he's kind of egging me about it right now. But if you go back to that small caps chart that Brian showed, I mean, small caps, for one, could be an interesting play right now, given the high growth expectations we have down the road. And small caps are generally, in the past, they have been able to handle inflation a lot better than large caps. So, small caps are an interesting breakout right now. Could be an interesting inflation play. Think about how your portfolio could act during a pullback and during inflation. It's always prudent to do that. So, if you're worried, there are things you can do, but do not underestimate the upside risk in this market. By the way, I did write a good piece a few months ago, actually. Oh, time. I wrote a good piece a few months ago about how to think about inflation when inflation sticks around. So I'll drop it in the chat, and I hope you read it. It expands a lot more on the cash flows now versus cash flows later idea. So bottom line here, no need to fear inflation quite yet. I know that's easy to say, but from the market's perspective, growth and consumer spending seems to be high enough to kind of abate that a little bit. But think about it in terms of your own money plan. And that's a great way to, kind of sum up everything we talk about here at Invest. So, Brian, that's what I'm watching. That's a whole big spiel. Tell us what you're seeing in the VIX.
All right, so we're going to start by going directly to the VIX watch list that we mentioned so often here on the stock play of the day. We do see the VIX down around 16%. We did have some weird activity. We talked a little bit about it last week. You don't put a ton of weight in the activity in that. We would have quite a few up days where we actually did see the VIX actually go up with it. Just a little bit more uncertainty in those bullish moves, but now that uncertainty has waned, and that we now see the VIX down back around that 16% level. But the one thing that I find interesting, we have the S&P up 22 today. The NASDAQ is up about 0.5% too to go along with that. But the December future, for the first time since we've been quoting the December future, has actually broken below the 20 level. And I have the 20 level highlighted here on the VIX chart over here on the right hand side. And that we've always talked about that being the line in the sand between high volatility and low volatility ever since we broke through it back in April. It always seems like whenever we get above that 20% level, nowadays it seems like that's the line in the sand. That's where we consider it high volatility in the actual VIX, the spot index, VIX, and some of the futures contracts. Sorry, excuse me. Okay. So in December, we have that futures contract actually coming back down below 20. But if we go to January and February, we see a little bit of a rise in implied volatility. The Fed will be meeting again, talking probably more about tapering, to be blunt. And I think that's created a little bit more volatility going out into the new year. All right. So short and sweet on the VIX. Let's talk about Target overall. All right, Kelly? And I'm going to pull up a chart on Target and kind of highlight a couple of things, but back to you.
All right. While you're pulling up that chart, let's talk about Target. But more importantly, let's talk about retailers, because this is where this conversation really started for Brian and I this week. So 'tis the season to do a little retail trade for a few different reasons too. Retailers, if you haven't noticed, they've been on a little kick lately, with S&P 500 retailers rising about 5% this month. A nice little gain relative to the market. And I'll tell you why this is happening. It's actually a very interesting story. So the supply chain trade, like I mentioned before, is unwinding. We're in the process of doing that. So that's lifted sectors like semiconductors, transports, and retail stocks. And we're focusing on that third one today. So retailers have that going for them. And didn't I say that the conversation around inflation has changed? Well, it's changed. But we're starting to realize that the problem with inflation is more of a too much demand problem, more than a too little supply problem. I mean, certainly supply issues are still there, right? You go to the grocery store and you see it being out of certain odd items. Like I went to the grocery store earlier this week and they were out of rice. Very weird. But anyway, there is a supply problem for sure, but we're seeing that there's really, really strong demand. So it's more of a demand issue. And that's not a bad place to be in. In fact, that's a better scenario for profit margins. And as we saw in earnings season, like I mentioned, consumers are digesting these higher costs pretty well. Plus, add on to it that it's retail earnings week, one of our favorite weeks of the season. And so far, we're getting some pretty bullish insight and outlooks for next year. The market has been mixed with these reports, though. You know, Walmart stock, Walmart reported this morning, and it's getting punished today because of slightly lower profit margins, even though the outlook was quite strong. And, you know, if you look at another retailer, Home Depot reported this morning as well. Home Depot is rallying on the heels of strong demand for houseware and a strong outlook as well. So the market is mixed for it right now. But overall, you know, the things that these companies are telling us, you know, look pretty bullish for the upcoming year. And as you all know, it's tough to overlook retailers during the shopping season, the holiday shopping season. I'm thinking about shopping. You're probably thinking about shopping. And there's a reason why, you know, retailers tend to do well at the end of November when you're thinking about shopping. So now this week, let's get to Target. We are looking at Target for our retail play. And we're all familiar with Target, that big box store with the red bullseye as its logo. Target is actually set to report its Q3 earnings before the bell tomorrow morning. So this could be more of a pure play on demand, with Target being more of a consumer staples type stock than a niche retailer. And I point that out because consumer staple stocks seem to digest inflation and higher costs, higher price pressures a little bit better than their niche retail competitors, just because they sell more things you need, like toilet paper, toothpaste, floss, you know, things you can't really pass up because the cost is too high. So we're looking at a consumer staple and an environment where prices are rising. Big box stores like Target generally have more pricing power just because they're bigger over the long term. So it's hard to be pessimistic on retailers right now with the sheer amount of demand and a healthy consumer. We can't say for sure. We can never say for sure. But, you know, it's hard to say now that Target is going to pop on the back of its earnings report. But it could present an interesting opportunity if you want to get a slice of that retailer space going into the holiday season and going into next year. So with Target earnings, we're watching Target's outlook closely on what the sector could look like going forward. And we're going to play it this week. So, Brian, I want to hear what you have for us in terms of a target options trade. So, I'm going to pass it to you in a second. But before I do, I want to remind everybody to please, please, please drop your questions in the chat because Brian and I will be answering your questions live at the end of the show today. Give us some brain teasers. We love hearing from you guys. So, with that, Brian, show us the trade.
All right. So before I do that, since I took the time to actually pull up the chart, let's show that chart. And there is something interesting. It looks a little bit like the S&P 500 index, not quite as of a strong move to the upside, but we do have the 200-day and the 50-day and the 20-day all lined up like they're supposed to. So they're all acting kind. They're all acting nice. But we did break out yesterday, had set a new high in target just a little bit. We didn't stay there long. But overall, right now, we're kind of bumping up against that. And you would kind of expect that it might just hang out here all day long, waiting for that earnings report, which is going to be on the morning, tomorrow morning before the open. They will announce their earnings overall. So because of that earnings report, it creates some things that you got to think about as far as your option strategy is concerned. So inside the options playbook, I'm going to show you two separate trades. We're going to build this as some people might wait for the earnings, but then again, you're right on breaking out to a new high. So what if the stock breaks out and I miss out of that opportunity? What could I do? But what if it comes back down because of the volatility? Well, if you're really thinking about getting long retail and Target in particular, going into the new year, one thing that we can do is sell a put spread with the intention of buying the stock if it comes down. So because of that, I approach the strikes a little different in that this is going to be the alternative inside the playbook to a cash secured put. So here's the cash secured put. And the concept in the cash secured put is that you sell a put at a strike price that you'd be willing to buy the stock, which is lower than where the stock is currently at. And you have the cash to buy that stock. So in our instance, I think we're going to be, if we sold the 26 strike or 200, let's see where the stock is at right now, 265. So it's a 260 strike put. If we sold that put, our intention would be that we would put in $26,000 in cash. We would have that available, just like if we put a limit order in on the stock, right? If you had a limit order to buy it at 260, you would plan to buy it at 260. You got to have the wherewithal to buy that 100 shares at 260, which is $26,000. In this instance, that's what a cash secured put works like. But don't like cash secured puts around earnings, mainly because you just have too much risk to the downside. And options are all about, in my mind, using them to kind of protect yourself. So you're getting a lot of premium because of the implied volatility levels being raised because of this known event that can make the stock move. So why not look at a short put spread? But keep the same concept. We're going to limit our risk to the downside. We're going to buy some protection, but we're still selling that put, saying that we're willing to buy that stock at that strike price. But if it goes too far down after earnings, well, we got another put here that we bought that's going to protect us. So this is one way where you can participate in the earnings report, saying that if it does come down, I'm going to take that opportunity to buy the underlying stock. But if it goes up, at least I'm going to get something, right? A little bit of something, because I'm going to bring in a net credit to the account, and we'll do it a little bit short term, which will give you the opportunity to go on out and actually buy the stock if you still want to buy the stock after earnings, if it does make a solid move to the upside. Now, was thinking about just doing the long call spread. That would be a little bit more bullish, and that would be out of the money, long call spread, hoping for the move to the upside after earnings. And that's a totally different way of approaching this fear of missing out. I don't want to buy the stock because of earnings, but in case it does go up, I still want to try to profit from a good, solid earnings report, or at least a perceived good, solid earnings report by the marketplace. Okay. So let's get into the actual trade, the short put spread. All right. So to start with, we have 3 days remaining to expiration. Whenever I'm looking at a trade around earnings, I want to know what the marketplace is thinking the underlying stock could do. So what does that mean? That's called the expected move. We have the underlying stock trading at 265. So the most at the money option contract is the 265 strike. If I just look at the ask price, the put's trading at 7, calls trading at 780. Let's call it 7 and 8. We'll say $15. $15 is it's not an exact science, but that's basically the line in the sand. If somebody was buying this long straddle, they'd be willing to pay $15 and they think it's going to go above, right? And if somebody's selling that, well, they're selling it at $15 and they think it's not going to move that much. So it's really the over under as far as earnings is concerned. And that is by that November 19th expiration, which would be this Friday. I'm going to go a little bit further out and I'm going to take that expected move into my concept. I want to buy the stock if it comes down. So I'm going to be right about the expected move. I want to be within that range that underlying stock could move. I don't, if the expected move is 15 points, I don't want to go 20 points out of the money. Why? Because the marketplace is saying that it probably won't move that much. Now, probably is always in quotes, as always, they don't know exactly where the market would move. And the expected move never has regard to direction. I want to emphasize that. Doesn't mean it's going down, doesn't mean it's going up. They're just saying that's the line in the sand going out to that November 19th expiration, 3 days from now. Okay, so I'm going to go down about 15 points. And I'm going to, with the market at 265, we're going to be selling the 250 strike put. We're going to go out 10 days. We're going to give it a few more days for this trade to live. We're going to sell the 250, and then we're going to go 5 points down, and we're going to buy the 245. Okay, so cash secured put concept would be we would sell the 250 strike, saying we'd be willing to buy 100 shares at 250. That would be $25,000 if we were put the stock at 250. Then we're going to say, hey, that's a lot of risk. They have earnings. Now we're going to go out and reinsure ourselves and buy the 245, limiting our risk to 5 points. Guess what? We get paid for doing that, right? We bring in cash. So in this instance, we're going to bring in an 85-cent net credit. Now, when I looked at it before the beginning of the show, it was $1 net credit. And I like $1 better than 85. Why would you have less when you could have more? But right now it's at 85 cents, so we're going to run with it. It's going to be an official paper trade. I'm going to put it in the right rail over here. And as always, especially around earnings, we're emphasizing that this is just a paper trade. You have to look at your portfolio, take these concepts that are inside the options playbook, these strategies, and apply them to your situation on stocks that you want to be trading that fit into your portfolio. So I'm going to go at a midpoint. Now, never guarantee a midpoint fill, and don't forget you got commissions. But in this instance, we'll say 85 to make the math simple. If we could get a net credit of 85 cents to the account, that means that that's our upside. If the underlying market stays where it's at, goes down just a little bit, or goes up, the options could expire worthless, and we can make 85 cents on this trade. If it comes down, our risk is the width of the spread, which is 5, minus that 85 cents, or $4.15. That's our maximum risk on this trade. But the concept is that we want to buy the underlying stock. So if it did come down, the plan would be to have the cash in your account to be able to buy it at 250, or basically buy 100 shares at 250, $25,000 overall. That would be the concept. And so if I'm thinking about buying a stock around earnings, I think that the short put spread is a very interesting way to do it, allow you to participate in earnings. And if it comes down, you get the opportunity. And I'm going to emphasize that if you don't consider it an opportunity to buy the stock lower, then this probably isn't the strategy that you want to be in overall. All right. So before I get to the questions, I also want to highlight something. I'm going to be doing a 3-part series at the end of the month, starting on November 30th. And it's going to be 3 one-hour sessions on the very basics of options. So if you have friends that are interested, please share it in social media. But we'll put in the chat box, well, actually, it's in our chat box, but we'll throw it in your chat box, options for rookies. And the number 4, or the word 4 is written out. So ally.com, options for rookies. Please click on that, register for the event, and share it with all your friends overall. All right, Callie, do we have any questions?
All right, Brian. Well, I'm just going to echo what you said. Ditto. It's going to be a fun time. Join us for for Brian's options course for rookies. It's going to be a 3-day course, and we're really excited for it. Yeah, So anyway, let's get to questions. All right. So I'm seeing a few in the chat. I'm seeing a few highs. I see a high from Zishan Nadim. Hi, Zishan. Apologies if I mispronounced that. Zishan asks, how can I follow your portfolio? Well, Zishan, I'm flattered. I really am. I can't tell you what I'm investing in for two reasons. First of all, I can't give recommendations. And two, I don't know what your plans and your needs and your goals are. I'm a different person. I have my own goals, needs, and plans. My portfolio reflects that. So, play the game that you're playing. I don't say that as like I don't want to talk to you about markets type thing, but just remember that you're kind of going for different goals. You probably have different objectives. So really trust in what you're investing in right now. And I can give you market insights, but only you know what's best for your portfolio. So that's a quick rundown of why I can't tell you what I'm investing in. All right, so I think we have a question for you. Oh, and I see a hi from Wayne. Hey, Wayne. All right, so question for you from Fire Mip Spy. So Fire Mip Spy asks, Brian, what is your collateral for a put spread?
All right. So yeah, I didn't emphasize that. You're correct. If you're just selling the put spread and it's 5 points wide, that means you got to have those 5 points in your account. So for example, if I'm doing it on a 1-by-1 basis, I'm entering this as a net credit to the account of 85 cents. The width of the spread would be 5 points. That's $500 less the credit received of 85 cents, or $415 is what is required in capital to put the trade on. Now, our concept was that we're going to do this as a way to maybe buy the stock if we do get a downturn overall. But with that said, the initial capital to put on the trade would be $415 less commission. Thanks for pointing that out. I didn't emphasize that because of the concept of the cash secured put alternative, I guess.
Yeah, good call, Fire Mip Spy. We always love our viewers keeping us honest there. All right. So Augustine Ramirez has a good question for you, Brian. So he says, hi, Brian. Hi, Augustine. So he asks, I bought the 150. Oh, this is a little incomplete. So I bought the 150 Apple call maybe and sold the $140 call. Should I let it get assigned or roll it over? So I would take that question as more of a, Brian, how do you think about, when to, let a trade get assigned or roll it over? What are the things you should consider when you're looking at a specific trade there?
Well, one of the obvious things is obviously what's your thoughts that are on Apple. We see Apple trading right around 151 at this point in time. And you sold the 140. So you wanted, I'm assuming you're missing a call in here. So you sold the 140 and you bought the 150. So to me, that's a short call spread and you want it to be below 150. Now the expiration is on the 19th. I think you're a little bit too late in this scenario. And I'll get that question a lot. And to me, it's kind of like, well, I drove my car off the cliff. How do I repair it? You've let it go too far. If we're talking about the 19th, there's probably not a lot of premium that's in on that position because you're fairly decent in the money. 140 call and 150. I don't know. You have 2 days remaining. I guess you'd have to go and you'd look at it, see if it's not trading for the $10 or close to the $10, the maximum of the width of the spread, you might roll it out and roll it up. But I think it's going to be very hard to do that right now and do it for a net credit to the account and basically go out a strike, maybe go up 5 points. So we're a little bit too close to expiration in order to make an adjustment on that trade overall. With that said, though, it's hard. Every scenario like that is very hard to consider. And actually, I get a lot of people that request me to add a chapter to the options playbook about adjustments. But that's the problem. The adjustments are easier to do if you do them sooner. In other words, and we do have a section about rolling covered calls that kind of applies to short spreads too. You don't want your short option contract to get too far in the money. So I would have considered the roll maybe when the stock was 142, 143, right? I didn't want it to get all the way to the 150 level before I considered actually doing the roll. And that's also true on cash secured puts if you're thinking about rolling them down and out, or covered calls where you're thinking about rolling up and out. And there is a section in the playbook, and I guess I'll highlight it. I'll bring it up about managing your positions. It's a little bit of a smaller section about it, but it talks a little bit about those concepts and about managing that premium of the short option contract that you want to roll. So right in here, rolling a actually it's rolling a short call spread. I do have one in here. I didn't think that made it to the website. Okay, rolling a short call spread. There you go. Wow, simple. I could have just said that, Callie, and I wouldn't have had to actually go through all that scenario. So there's a section on it.
Well, the story that Brian's not telling you is he actually didn't have a chapter on that, but he wrote it in his head, transported it to the website.
I didn't think it was in the website. Yeah, no problem.
That's how big of an options guru he is. But thank you for pointing that out. It was a great answer. Check out the options playbook, everybody. It's really great. It teaches you the basic and a few more intermediate trades that you could learn as you're starting out with options. And again, sign up for the Options for Rookies course. It's going to be a lot of fun, and Brian will be there walking you through, how to use options in different scenarios. So I'm going to go ahead and wrap this up. I don't see any other questions, and it's 12:31. Thank you, as always, for joining us. We always have so much fun with you. And I'll remind you to tune in on Friday, because every Friday, Brian revisits our trade in a special edition of Stock Play of the Day called Stock Play of the Day Overtime. Get it? So Brian's going to revisit the trade. It's going to be 12 p.m. Eastern right here on Ally's YouTube channel. So definitely swing back, see how we did.
And I want to say one thing, because the last question we talked about getting assigned. You don't want to get assigned on the trade. The brokerage firm, especially if you're going to end up being short stock and you don't have the ability to be short stock, the broker might close you out. So I would prefer to close myself out than to allow the broker to come in, because they're going to come in at the market and close it out. So I just wanted to make sure I emphasize that with only 2 days remaining to expiration. And with that said, that's it for this edition of the Stock Play of the Day. Please click subscribe, ring the bell, and I'll see you this Friday after Target's earnings to talk a little bit about our short put spread in Target. Thanks for coming, everyone.